How business owners should prepare for the 2026 Nigeria tax law. To prepare for the 2026 Nigeria tax reforms, business owners must review their corporate structure, update their financial processes and technology, and train their staff on the new regulations. The new laws consolidated into the Nigeria Tax Act (NTA) 2025 introduced significant changes affecting companies' income tax (CIT), value-added tax (VAT), capital gains tax (CGT), and the overall tax administration system. Summary of the key changes for businesses. The reforms include the renaming of the Federal Inland Revenue Service (FIRS) to the Nigeria Revenue Service (NRS), and a simplification of company classification into small and large small companies, defined by specific turnover and asset thresholds, are exempt from CIT, CGT, and a new development levy. For large companies, the CIT rate will decrease from 30% to 25% starting in 2026. A 4% development levy is introduced on assessable profit for all companies except small and non-resident ones, replacing several existing taxes. The CGT rate for companies increases from 10% to 30%. To align with the standard CIT rate, multinational and large Nigerian companies face a minimum effective tax rate (ETR) of 15%. Businesses are now mandated to use electronic invoicing systems for VAT and can recover input VAT on services and fixed assets, with the VAT rate remaining at 7.5%. Penalties for non-compliance have significantly increased. A new Economic Development Tax Incentive (EDI) replaces the pioneer status, offering a 5% annual tax credit on qualified capital expenditure. Transactions monitoring is increased, with financial institutions reporting monthly transactions over 100 million for companies. An independent tax ombudsman office has been established to handle taxpayer complaints and disputes. Now, what to do as a business owner? Number 1. Perform a comprehensive impact analysis. Review your financials to determine your company classification and associated tax liabilities. Update budget models to reflect the new development levy and tax rates. Evaluate how VAT changes will impact your supply chain and pricing. Number 2. Upgrade your compliance systems. Implement NRS-approved e-invoicing and fiscalization systems, digitize financial records, and utilize software to automate payroll and tax calculations. Number 3. Update tax strategy and governance. Work with tax professionals to adjust your tax strategy, particularly for large corporations and multinational subject to the minimum ETR. Explore eligibility for the EDI. Create a tax risk register and review the impact on foreign operations. Number 4. Train your people and engage stakeholders. Now, train finance, HR, and management teams on the new laws. Communicate changes to employees, vendors, and investors. Number 5. Ensure ongoing compliance monitor updates from the Nigeria Revenue Service and utilize accredited tax agents for filings. Familiarize yourself with the process for using the Tax Ombudsman Office.